Next thing I want to get into is dividends. So let's take a look at some of the accounting for dividends here. One of the things that companies are supposed to disclose, especially big ones, they're supposed to disclose their dividend policies. Now, generally speaking, companies do not distribute their entire amount of earnings, okay? In fact, you've got some companies like Microsoft that didn't pay a dividend for, the first 20 or 25 years of its existence. And it did that so that it could finance growth and expansion. I think this is the number one reason that companies will retain their income instead of paying it out as dividends, is to grow the company, Some other reasons might be to, you might have creditors that do not want you to be distributing the full amount of your retained earnings out as a dividend. They might have some loan covenants and so forth. State and corporation requirements. This is from your textbook, but I've never heard of that or seen that before myself. Another thing that might happen is your earnings can be increasing perhaps, or even decreasing, going down, and the company will continue to pay a particular dividend. And they'll pay this dividend at a particular dollar amount that investors are used to, and it's sort of a smooth amount that the investors can depend on. Like my old company, Dow Chemical, there are people, elderly people and so forth, that live on their Dow Chemical dividend check that comes in every month, and so Dow kind of keeps their dividend payment about the same every dividend period. So that happens. And then you could also build up earnings as a cushion against future losses. But the biggest reason is right here. I should have moved this up to number one, to keep funds in the business to finance expansion. If you're paying out all of your income, it's difficult to grow the company, okay?
I have a question. Because some companies don't often issue dividends to their stockholders or shareholders, what would be the purpose of having like a preferred stock in a company that doesn't really issue dividends?
Yeah, good question. A lot of companies, especially in their periods of growth, they're not paying dividends. And so if you're buying stock in a company, you may buy a company stock where they're paying a dividend, or you might buy stock where they're not paying a dividend. For example, if you back in the day were buying Microsoft stock, there's no dividend. You'd be getting zero dividend. And then you say, well, why am I buying the stock? Well, you're buying it because of the growth potential of that stock, the market price going up. And of course, if you had bought a boatload of Microsoft stock years ago, it's gone up in value so much, you'd be really rich, okay? So dividends are just one way of compensating investors for their investment. But now let's say that the company is matured, it doesn't need the funds for reinvesting. And in the case of Microsoft, the investors started getting uppity about the dividend, saying, hey, listen, you got to pay a dividend. Please pay a dividend. You got to pay the dividend. And Microsoft was not wanting to pay the dividend. And then finally, somebody figured out that the company, Microsoft, had enough cash in the bank that it could pay its employees their salaries for 7 years without having any additional cash inflow into the company. So it was obvious they had huge amounts of cash. They didn't need the money for reinvestment. And at that, Microsoft started paying a dividend. So it just kind of depends. Now, if you're not going to be paying a dividend, it's probably not a good idea to issue preferred stock where it looks like you're going to pay a dividend, but you're not.
Okay, right.
Yeah, so you're probably not going to be issuing that preferred stock if you're not going to be paying a dividend, because if you've got a preferred stock out there in the marketplace and you're supposed to be paying a 6% dividend and you're not paying it, it makes you look pretty bad. It's a pretty bad thing to do. So some companies pay dividends, some don't. And the bottom line is investors can build their wealth through the investments, whether the dividend is paid or not, through stock appreciation. Now, your dividend policy is something that the SEC really encourages, being part of your financial statements. So in the notes to the financial statements, companies want to disclose their dividend policy. Do they plan to pay a dividend? Do they have earnings, but they're not paying a dividend? Perhaps why are they not paying a dividend? Do they expect to pay dividends in the foreseeable future or not? And if they're paying a dividend, the SEC would also like the company to disclose whether or not they anticipate the continued payment of that dividend. So it's a good idea to be pretty forthcoming with your dividend policy so that investors can be aware. Now, there are several types of dividends. First is a cash dividend, and that's the one that is far and away the most popular. It's when the company pays out cash. Secondly, there's property dividends. Property dividends happens when the company gives property like land or products or something like instead of cash. That's the dividend. So here you are, an owner like at Dow Chemical one time. They gave a property dividend in the form of Ziploc bags, which they made at the time, Ziploc bags and Dow tub and tile cleaner. And so everybody who owned stock got a bunch of these products. And when I worked at Dow, I remember the property dividend had been distributed before I got there at Dow, before I worked there. And I was going to Publix during my lunch hour. And they said, "What are you going to get?" And I said, "Well, I'm going to get some groceries, and I got to get Ziploc bags." And Ziploc bags, don't get Ziploc bags. Nobody here buys Ziploc bags. Why not? Well, because we got them. The company gave them to us as stockholders. We all got tons of them. Hold on just a minute. They called somebody and they brought over several boxes of Ziploc bags because these employees were all shareholders in, because of the stock dividends that they'd been receiving. I mean, the stock compensation plans that they were in. And so they got all these, these shares, and they just had tons of these Ziploc bags. So I was able to use those. So that was a property dividend. But it can be land. It could be that they own stock in another company, so they give the stock away. Not real popular, but companies do it. And then there's this thing called the liquidating dividend, which is, we'll talk about it more in a minute, but it's not really a dividend at all. I'm going to put it in quotation marks, liquidating dividend, because it's really not a dividend per se, but rather it's a redistribution of the investor's original investment. Okay. And then you might also say number four, it's not on the list, and I wouldn't put it on there, but it's mentioned down here. You've got a stock dividends. Instead of giving money or property, what happens here is we give out company stock. Now, all of these dividends, all these top ones here, all of these are, the first three are going to reduce stockholders' equity. But the stock dividend will not. The stock dividend will not reduce stockholders' equity. So the first ones will reduce stockholders' equity, and this will not reduce stockholders' equity. And we'll see more about that later. Now, when it comes to dividends, and you probably know this from your earlier accounting courses, there are a few things that go on here. First of all, in order for the company to pay a dividend, the board of directors has to vote on it, and they declare the dividend. They declare a dividend. So what happens is, at a board of directors meeting, a motion is made where somebody stands up and say, "I declare that we should pay a $500,000 dividend in cash." And then some other board member will say, "I second the motion." And then the board of directors will vote on this. And if they vote yes, that means the dividend is declared and it is going to be paid. You say it's going to be paid. Once the dividend is declared, the company really owes the money. They've got to pay it. Now, interestingly, the board of directors does not have to declare the dividend. So they say, somebody makes a motion to pay a $500,000. I make a motion to pay a $500,000 dividend. I second the motion. And then they have a vote, and the vote fails. Okay. Maybe it fails because the company does not have enough money right then, you know. Maybe it fails for some other reason. Maybe they need the funds for some expansion. So if the board of directors fails to declare the dividend, no dividend is going to be paid. Now, this is significant because you could have a preferred stock where the shareholders are expecting, a 6% dividend. And if the board of directors does not declare the dividend will not be paid, won't be paid. So just because you have preferred stock doesn't guarantee that you're going to get the dividend, because the board of directors must declare that dividend. Now, once they declare the dividend, the company's got to pay it. So they've got a liability to pay that dividend. Now, regarding what stock they pay the dividend on, they only pay a dividend to the shares outstanding. In other words, no dividend is paid on treasury stock. Now, as a practical matter, sometimes in these huge corporations, it becomes complicated, right? All the accounting and systems and all that stuff are complicated. So what the company will do is they will actually pay a dividend on treasury stock. But who owns the stock? The company. So the checks on the treasury stock are written to the company. They're written to the company. And then when the company records the dividend coming in, what they do is they reduce they go to the same account that they used to create the dividend. So they reduce the amount of the dividend that they issued. In other words, they take it back to retained earnings or to cash dividends. Now, there are 3 dates that become important, and you probably know about these from your prior accounting. The date of declaration, that's what we're talking about up here. The date the board of directors declares the dividend. The date of record, that is, let me try to explain this a little bit. When the board of directors declares a dividend, imagine a big company, they declare a $500,000 dividend. Can they pay the dividend at that moment? Can they say, oh yeah, Molly, Jimmy, bring in some checks, bring in the checkbook. We're going to start writing dividend checks right now. Come on, get your pens ready. Get your pens. Here, I've got some markers. Use these beautiful markers here. We'll write all the checks. We're going to write all the dividend checks today. It's impossible. They can't write all the checks that day for a couple of reasons. Number one, because there's so many checks, they got to get, ready to go. They got to print the checks and stuff. Run them through their computer instead of writing them all by hand. Number two, they don't even know who owns the stock. The company does not even know who owns the stock as of the declaration date. And here's what I mean. Let's say that I own some Dow Chemical stock and I sell the stock to Stephen. Okay, so Stephen, now you've got the Dow Chemical stock. I just sold it to you. Okay, so you've got it. And the day after I sell it to you, Stephen, the board of directors declares a dividend. The thing is, I still own the stock according to the company's records. I am the owner of record because you, Stephen, have not had enough time to register as the new owner. And so you go to register as the new owner, and it is not something you do in a minute. You might take a day or two to, before you get to it. And so what happens is the company will provide a couple of weeks, 2 or 3 weeks period of time, Stephen, for you to register as the new stock owner, so you get the dividend. So this line in the sand date as to when you better register as the owner to get the dividend, it's called the date of record. And what this means is that any shareholder who owns the stock according to the company's records will get the dividend on that date. So the owners of record as of this date will get the dividend. So Stephen, if you don't register as the new owner quick enough, you could lose out on that dividend. So you want to register, quite quickly so that you are the one that receives the dividend. Now, Crazy, you go ahead.
And for the date of declaration, does the board give a month's notice as to when the date of record needs to be updated, or?
They usually give like 2 or 3 weeks, 2 or
Okay.
3 weeks, probably less than a month, but it's up to them. And it's usually something that's very reasonable. And it's funny because, you know, Steven's got 2 weeks to register. And let's say after he holds the stock for a week, he sells it to Michael. So Michael, now you're going to own it after a week. Well, Michael, you can very quickly register as the owner, and then Michael, you will receive the dividend instead of Steven. So how does that work? Well, how that works is Steven will know that you're going to get the dividend and that he's the one that's supposed to get it. So what he will do is just increase the stock price a little bit based on the notion that a dividend is coming. Okay. So, but anyway, whoever is on the records as the owner of the stock, that's who's going to get the dividend. And these records are usually kept not so much by the company, because the companies, you know, they're doing so many other things. They have specialists that handle, you know, keeping track of who owns the stock, and they call them transfer agents, where they sort of keep track of all of this. And so that's who's going to keep track of who owns the stock. Now, once we figure out who owns the stock, then we can't just immediately pay the checks. We've got to make sure that our records are correct. We got to look them over. Then we got to print the checks. So the payment date, we got to give ourselves enough time to prepare the checks and mail them out, which would be, say, another 2 or 3 weeks. So you have, you know, between this time period and this one, you've got 2 to 3 weeks, 2 to 3 weeks. And then from this date to the time the checks are mailed, you've got another 2 to 3 weeks time period. So there you go. That's what's happening. Now, what entries are made for this? And you may already know this. But anyway, let's take a look. So we've got this situation where the company has 1.8 million. This is written a little bit light here, but 1.8 million shares at 50 cents a share. The dividend amount is going to be $900,000. So we're paying a dividend of $900,000. That's what all that is saying. So on the date of declaration, which is June 10th, what do? Well, you could say, oh, don't do anything because you're not paying it. No. You have to make an entry. Why? Because once the dividend is declared, the company has a liability to pay the dividend. So we're going to go ahead and credit dividend payable, and we're going to debit retained earnings. Now, some companies, in order to keep their retained their dividends, you know, segregated from other retained earnings, they will set up a special account for dividend payments, which is a contra retained earnings account. So it's part of retained earnings, but it's earmarked to handle dividends. And what they'll do is they'll go ahead and use a cash dividends account. And I think what your textbook says, instead of just saying parenthetically cash dividends, they say cash dividends declared. So, but for academic purposes, a lot of times we just take it to retained earnings. So we're going to debit retained earnings for $900,000. And again, this is on the declaration date, and we're going to credit. We can't credit cash because we're not paying it now. We're going to credit dividends payable. For the $900,000. Now, on the date of record, so this creates a liability to pay the dividend. On the date of record, there's no entry, no accounting entry. All we do is sort of look at our stockholder records to see who owns the stock. So there's no accounting dividend entry. On the date of record. No entry then. But then on the payment date, obviously, we got to go ahead and record the payment of the dividend. So what we're going to do is debit the dividends payable for the $900,000 and credit cash for the 900,000. One other note is if it is a cash dividend, a lot of times instead of using an account called cash dividends or cash dividends declared, companies will just use an account called dividends. But if it's a property dividend, you don't want to put it into just a regular dividends account. You want to say property dividends. But for cash dividends, we can pretty much assume that the dividends account would be for a cash dividend. But a property dividend, you want to put it in a property dividends account if you're using separate accounts. And I say that because for financial reporting, you're supposed to indicate the dollar amount of your total dividends, and the dollar amount of your cash dividends, which could be different amounts. Any questions about this? Okay. Now, sometimes companies will issue a property dividend. I think this is kind of a crazy thing. Can you imagine getting a property dividend in the form of land? They could give land as a property dividend. Oh, yes, I have land. I have land in Wyoming. I received it as a dividend. Well, how big is the land? Well, they had to split it up among all of the shareholders. My piece of land is about this big. What are you going to do with that? Shares of stock. How are you going to distribute shares of stock equitably among your shareholders? Maybe each person gets half a share. I don't know. So giving property dividends is somewhat problematic, especially for big companies. The only time I've actually seen a big company do it, and I didn't see it, I just heard about it later, was the product dividend that the owners of Dow Chemical got. The Ziploc bags and the Dow tub and tile cleaner. So what happens? Well, on the thing is, let me see if I got an example here. Hold on just a second. Oh yeah, here we go. The thing is, let's say that we're giving a property dividend, and what this is some stock. Maybe we own some, Microsoft stock. The company owns some Microsoft stock, and they're going to give it out in the form of a dividend instead of cash. And the cost of this stock was $1,250,000. That's the cost. And let's assume that this stock is on our books at the $1,250,000. And then later on, the company decides they are going to give this as a stock dividend, as a property dividend. And so the board of directors is trying to decide. Can you imagine this? You're in a board of directors meeting, Minghui, Stephen, Michael, you're all in the board of directors meeting. You're all in the board of directors, and we've got this stock that we bought for $1,250,000. And instead of a cash dividend, we're going to be giving this stock away. And I declare the dividend. I declare that we distribute our equity investment in Microsoft, which had a cost of $1,250,000. I declare that we should give that as a property dividend to our shareholders. And then somebody seconds the motion. I second the motion, So there we go. You guys might have a question, such as, I know our cost was $1.25 million, but how much value will we be giving to these shareholders now? How much is it worth today? And we say, oh, the market value of it? Oh yeah, the fair market value of the stock today is $2 million. So they'll, come to think of it, the shareholders are going to like this a lot more. Oh my God, I didn't even think of that. Well, you guys, Michael, Minghui, and Stephen, you would have thought of it. Hey, how much value are we giving to these shareholders today? And you would base your decision on what? The cost or on the fair market value at the date of declaration? Well, you're going to base your decision on, the dividend based on the market value of the stock today. So you look at it and you say, okay, let's think about this. Should we give our shareholders $2 million worth of stock? And we all talk about it. We vote and say yes. Let's assume that Michael, Minghui, Stephen, you all vote yes. We're going to give the $2 million worth of stock. And the declaration date is December 28th. So we go ahead and do that. Well, we made the decision based on this fair value. So what we've got to do first is to revalue the equity to its fair value as of the declaration date. So on the date of declaration, we adjust the carrying value of the asset to its fair value. So what I'm going to do is I'm going to, on this date, December 28th, I'm going to debit equity investments and it's already on our books at the 1.125 million. It's already on our books at 1,250,000, but we need to bring it up to 2 million. So I'm going to debit the equity investments for $750,000, and then I'm going to credit gain on equity investments for the 750,000. There we go. So I've just brought it up to its fair value. So now it's on our books. Now it's on our books at the 2 million. And now I want to record the declaration of the dividend. So I'm going to debit retained earnings or property dividends. Yep. Yeah, I think so. Not just dividends, but you want, since this is a property dividend, make sure you call it a property dividend for the $2 million. And then you credit property dividends payable for the $2 million. So there we go.
What kind of account is gain on equity investments?
It's an income statement gain account.
Okay.
Yeah, goes right. It's a regular gain account for your income statement. And now let's go ahead and on the date of record, we don't make any entry, but on the date of distribution, obviously, what we're going to do is debit property dividends payable for the 2 million and credit equity investments for the 2 million. And there we go. So that's a property dividend where we're giving stock out to our owners. And it could have been land, it could have been product, it could have been anything. Don't confuse a property dividend with a stock dividend. Okay, that's a little bit different thing. Any questions? Next thing I want to talk about is something called a liquidating dividend. Liquidating dividends. And I'm going to put little quotation marks around this because dividends, basically dividends, would be a distribution of earnings to shareholders.
Professor, I actually have a quick question.
Sure, yeah.
So at the date of distribution,
yep.
Because you're debiting property dividends payable, when would that account have been created?
Oh, let me go back. Give me a second. When we remember when we recorded the dividend, the declaration of the dividend.
Right. Okay, that's where you. Okay.
There, yeah. See, we boosted the equity investment so that if we look at this investment account, T account for it, it goes from 1,250,000 plus we had the 750 to bring it up to the $2 million.
Right.
And then we declare the dividend and create the dividend payable account.
Okay, cool.
Hey, Steven, another question you might have is, what happens if the value of the equity continues to increase? Do you adjust it again? And you probably don't, because number one, the dividend is going to be paid out very quickly, and number two, the dividend decision was based on this fair value. So once you boost it to the fair value as of the dividend declaration date, you're probably going to leave it alone.
Mm-hmm. Okay, thanks.
So then after that, once here's the dividends payable account. So once we pay the dividend, we're going to go ahead and clear that with this entry right here. Here we go.
Okay, sounds good. Thanks.
Good deal. Next thing I want to talk about is this liquidating dividend idea. In order to pay a dividend, the company needs a couple of things. Number one, they need cash or some property, so they got to have cash or property. Number two, since dividends is a distribution of earnings, they need retained earnings. Now, let's say that we've got a company and they want to pay a dividend. Just a second, I'm sharpening this pencil. Sorry about that. They want to pay a dividend, but they do not have any retained earnings left. They don't have any retained earnings. Well, if they pay a dividend without having enough retained earnings, it's not a dividend at all. Instead, it's giving back or liquidating part of the owner's original investment in the company. So sometimes companies want to pay dividend, they don't have enough cash, but still they want to pay the dividend in quotation marks, and if retained earnings is not enough for any dividends in excess of the retained earnings, must reduce a paid in capital. So liquidating dividends are going to reduce your paid in capital. That is a dividend that is not a distribution of earnings, but instead liquidating part of the owner's investment. You got to take it to paid in capital. Now, sometimes the company will have some retained earnings. If they've got some retained earnings, the amount of the dividend associated with the retained earnings they have is not a liquidating dividend. It's a regular dividend. The liquidating dividend would be the part of the dividend that is in excess of the retained earnings balance. So you could pay out a dividend where part of it's a liquidating dividend, and therefore you got to hit a paid in capital account, and part of it's a regular dividend where you're going to be reducing retained earnings. Any questions about this? Well, let's go and take a look at an example. Here we go. They want to pay a dividend of $1.2 million. So the total dividend is $1,200,000. They have retained earnings of $900,000. So that's going to be a regular dividend. And the difference is going to be the liquidating dividend, which is $300,000. So we're going to make entries that will include a regular dividend and a liquidating dividend. The regular dividend will take it to retained earnings, but a liquidating dividend has to go to what kind of an account? liquidating dividend must be taken to what kind of an account, everybody? Come on, speak up.
Paid in capital.
Exactly. It's got to be taken to a paid in capital account. So the entry for this is going to be a debit to retained earnings for the 900,000, or you could take it to cash dividends. And then we're going to debit a paid in capital account. Now, if this is a no par company stock, in other words, there's no par value and it's for common stock, the dividend's being paid on common stock. If it's a no par common stock, then you debit the common stock account. But if it's a par value stock, like they got a par value, what you're going to do is debit the additional paid in capital on common account. So let's go ahead and do that. Let's assume there's a par value. Is used for the stock. So we debit additional paid in capital for the 300,000, and we credit dividends payable for the 1,200,000. So that's at the declaration date. There you go. Now, on the payment date, we got this first entry on the declaration date. So on the payment date, all we got to do is debit dividends payable for the 1,200,000 and credit for the 1,200,000. So there you go. So if I were to ask you a liquidating dividend must include a debit to what kind of an account, what would you say? Go ahead, Michael.
Paid in capital account.
That's right. That's right. Now, this entry we made a couple of minutes ago, this one here, the only part of this that's a liquidating dividend is right here. This one. This is part of the liquidating dividend. Liquidating dividend here. This part up here, is this a liquidating dividend? The 900,000?
No, that's just regular.
That's regular. That's regular. So for our liquidating dividend, we got a credit to the 900,000. Now, I mean, to the credit to the additional paid in capital. Now, it could be that the liquidating dividend that you're paying has no component of the retained earnings part. That happens too, so that's not a, in that case, you just take it all to the paid in capital account. Any questions about that? Well, the next thing we're going to get into is stock dividends and stock splits. Stock dividends and stock splits. A stock dividend is when a company provides its shareholders with more shares of stock. Let's say that you own 1,000 shares of Walt Disney stock. And Walt Disney Company decides to provide you with a stock dividend. So you own 1,000 shares of stock. And let's say they're going to provide you with a 300% stock dividend. How many shares of stock you're going to get in this dividend? Just holler out. You own 1,000 shares. They're giving a 300% stock dividend. How many shares of stock are they going to give you?
3,000.
3,000 more shares. Oh my God, you're going to get 3,000 more. And so you're going to have a total of 4,000 shares of Disney stock. Oh my God. Probably going to be pretty happy. But the thing is, if the selling price of this stock at the beginning, when they started out with is $200 a share, by the time this stock dividend is all done, what do you think the new selling price of the stock is going to be, approximately?
The fourth or third price?
Huh?
Probably like $50.
Yeah, like $50. It's going to go down to like $50. $50. And in fact, companies will do these stock dividends to try to move their stock price as they like. In fact, this is an actual example taken from the Walt Disney Company when the stock was selling for like $200 a share. And they did this huge stock dividend to increase the number of shares to bring the selling price back down to about $50 a share, which is kind of where they wanted it. Now, this is a big, what we call a large stock dividend. It's huge, huge. And a large stock dividend would be any dividend greater than about 20 to 25% of the shares outstanding. Greater than about 25% of the shares outstanding. So this is a large stock dividend. On the other hand, a company, let's say that you got some Dow Chemical stock, And with this Dow Chemical stock, you own, 10,000 shares of Dow Chemical. And Dow Chemical gives a 10% stock dividend. So 10% gives you another 1,000 shares, So are you happy? You're probably happy. You probably like the idea. It's probably a pretty cool thing to do. Now, if the price of the Dow Chemical stock was selling originally at 100, and then they did this 10% stock dividend, so the stockholders, if you own Dow Chemical stock and they sent you an extra 1,000 shares just for fun, you'd probably be happy about it. All the owners are going to be happy about it. And so what's the new price of the stock going to be? Once you get 11,000 shares of stock, the new price per share is going to be, I don't know if it's going to go all the way down to, would it be 91, or could it go down to, maybe it won't go down that far because everybody's so happy. Maybe it'll go to 95. I don't know, something like that. But it'll decrease. But the decrease is not huge like we have here. Not huge. Now, the thing about these stock dividends, in a way, shareholders get really happy when they get these stock dividends. They love it. It's just wonderful. But in another way, it just doesn't matter much. It doesn't matter much because it's sort of like when you order a pizza at Domino's. When you order a pizza, they take they cut it up. They cut it into 8 pieces. And how they do that is they run the knife through 1, 2, 3, 4 times. And once they do that, they've got 8 pieces of pizza. Now, if you say to them, oh, I want more pieces of pizza, no problem. How much more will it cost? We'll give you an extra 8 pieces of pizza for free. Really? 8 more pizza for free? Yes, we will. How are they going to do it? Easy. They just run the knife through there again. Run it through another, and now you've got 16 pieces of pizza. But you all know the amount of pizza you got is the same. You don't get any more pizza. You just get smaller pieces of the same pie, right? And that's what happens with these stock dividends. A stock dividend, what it does is it does not change the amount of total equity. The investors do not have any bigger stake in the company. The equity doesn't go up. It stays the same. It's just that the equity is cut up into smaller pieces. Now, in any case, what we're supposed to do is to record the dividends. We're supposed to record these stock dividends. Now, I want you to notice that with the large stock dividend, the price of the stock, the fair market value, see this fair market value? It plummets. It plummets. The fair market value in a large stock dividend, and a large stock dividend is, again, a dividend greater than, say, about 20, 25% of the stock outstanding. because the fair market value of the stock will plummet. In accounting, we view this situation as one where the fair market value of the stock has very little relevance in the transaction. On the other hand, for a small stock dividend, where the fair market value goes down, but it doesn't plummet. It doesn't go down horrendously. It just goes down some. It goes down some. We know it's going to go down. How much, we're not sure. But because it doesn't plummet, what happens is we view the fair market value as having more relevance in the transaction. Now, this is significant. This is significant because for a small stock dividend, what's sometimes called an ordinary stock dividend, which is less than 20 to 25% of the outstanding shares, the amount that we're going to use to record the transaction is the fair market value of the stock, because the fair market value doesn't go down too much. So we'll base the transaction when we record it on this fair market value at the beginning. On the other hand, for the large stock dividend, where the fair market value plummets and really loses relevance almost entirely, we could still try to figure it out. But instead, in accounting, we don't do that. And instead, what we do is we use the par value. So for a large stock dividend, we're going to use the par value of the stock to record it. And I know these notes are just sort of cryptic, but don't worry about it, because I'm going to give you an example in just a moment. So let's start with a small stock dividend, an ordinary stock dividend. Let me get my calculator out here. I got it ready. So I'm going to make this example up as I go. Let's say that the company has 100,000 shares of $1 par common outstanding. And it wants to issue a 10% stock dividend. So we're going to go with a 10% stock dividend. That means 10% of the 100,000, they're going to issue 10,000 new shares of stock. Let's also assume that as of this date, the fair market value of the stock is, $8 per share. Just making up some number. So now what we've got to do is go ahead and record this transaction. Now for this transaction, will we be recording it based on the par value or the fair market value? Guys, how many people say the par value? Raise your hand. How many people say fair market value? Raise your hand. Oh yeah. We're going to go with the fair market value. So, and when we record the transaction, what we're going to do is what they'll capitalize part of retained earnings. So what we're going to do is we're going to take retained earnings and we're going to transfer it into a paid-in capital account. That's what we're going to do. That's what we're going to do with this. So in order to do this, in order to record the transaction, what we're going to do is we're going to debit retained earnings to decrease retained earnings. And that's going to be, let's see, how many shares? 10,000 times, well, that's a lot of money. 800,000? No, $80,000. So 10,000 times 80,000, which is the 10,000 shares we're distributing times the $8. And then what we're going to do is credit common stock. But this is as of the declaration date. And so we have not distributed the stock yet, okay? So what we're going to do on the declaration date is debit common stock distributable. Common stock distributable at the par value for the common stock. So that's going to be the 10,000 times 1, so it's going to be 10,000. So we credit common stock distributable at the par value. So I'm going to just put in here at par, because I don't have room to write the whole calculation. Then I'm going to credit the regular old additional paid-in capital. Additional paid-in capital on common for the $70,000 to balance the entry out. So that's the entry that we're going to make on the declaration date. Then you have the date of record that comes along. And then on the payment date, what we're going to do is debit, on the payment date, we're going to debit common stock distributable for the 10,000 and then credit common stock for the 10,000. When it's a small stock dividend, I like to think of it as one where the price of the stock before and after the dividend will not be too terribly different. The price of the stock will stay about the same. And so with a small stock dividend, what we can go ahead and do is to use the fair market value of the stock, because it won't change much. And I like to think of it this way because it gives me some method of remembering, how to handle each of the dividends. Now, for a large stock dividend, things are different. For a large stock dividend, the price is going to change of the shares is going to change dramatically. And therefore, instead of using the fair market value of the stock, we should use the par value of the stock. So let me make up an example now for a large stock dividend, just making something up, just coming up with some numbers here. Let's say that we have 200,000 shares of stock outstanding. The par value is $1. The fair market value is, say, I don't know, anything, $13. And we're going to issue a 300% stock dividend. So there we go. So those are the facts and figures. So the first question is, how many shares are we going to issue? Well, the 200,000 shares times 300% would give us, how many is that? 600,000 shares? So 600,000 new shares of stock will be issued. And we will be issuing these, when we capitalize the retained earnings, because it's a large stock dividend, larger than, say, 20 or 25%. So in the pronouncements, it does not say, oh, it's this percentage or that percentage. It gives you a range. So it's, say, 20, 25%. Obviously, on an exam, I'm never going to give 22%, because then you'd have to decide. So I'll either give well under 20% or more than 25%. But there is a little bit of judgment that comes into play for a stock dividend in the 20 to 25% range. So let's go ahead and record this. We should debit retained earnings. And then we're going to credit common stock distributable. Or the 600,000. And so it's,
I have a quick. So is the 600,000 equal to the 600,000 new shares times $1 par?
Yep, that's right. That's
okay,
right.
so if it was like $2 par, then you would just do 600,000 shares times whatever the par value was.
Yeah, that's right. So I'm going to say at par here, at par. at par. And then once the on the date of record, we don't do anything, but on the issue date, on the the payment date, we're going to go ahead and debit common stock distributable for the 600,000, and we're going to credit common stock for the 600,000. There we go. So that would be a large stock dividend. Okay, now let's look at the stock dividend thing. We had a 300% stock dividend. And what happens here is somebody has a share of stock, so they've got one share of stock, and they get 3 additional shares. So the dividend gives them another 3 shares. So 300% of 1 share is 3 shares. So this is what it kind of looks like. And once it's all said and done, they've got a total of 4 shares. Everybody see that? Now, on the other hand, there's something called a stock split. Now, the way the stock split works is we start with, let me cover this up for just a minute. We start with 1 share of stock. So we got this share of stock. And let's say we want to end up with something similar to what we would have if we did a 300% stock dividend. So we want to end up with everybody who's got 1 share will end up with 4 shares. So with the stock split, what we do is we go ahead and we take this share of stock and we just split it up. We split it up. So there we go. We split it up. So here's 1 of them, 2, 3, 4. 4 of these. You got it? So we're going to split this share up. So let's go ahead and do that. And here it is. This one, here's this new share here. Okay. And then this one is this new share down here. This section becomes this, share here. And this section becomes this share here. Now the question is, if you're going to split up this stock, and it originally has a $1 par, and now, so the $1 par, but if we split this share into 4 pieces, what's the new par value going to be? Can we split a $1 par and have $1 per share? So the answer is no. It's going to be 25 cents. So the par value is going to go to 0.25 for each of these. 25 cents per share. So when you do a stock split instead of a stock dividend, what happens is the number of shares, goes up. Of course, this is a 4 to 1 stock split here, which is kind of equivalent. It's like a 300% stock dividend, in that the number of shares you end up with is the same as though you gave the stock dividend. So it's very similar. And it's a 4 for 1 stock split, but it's a 300% stock dividend, because you'd get the 300% for the new shares, and you still have the 100% of the original share. That brings you up to the 4 shares, you see. So when you think about it, these two are quite similar. Now, the thing is, if we go back to our example we had just a minute ago here, this one, where we're going from 200,000 shares to 600,000, if you look at the par value of this, let's see what entry we need to make. We originally had 200,000 shares times the $1 par. So in the common stock account, we had a total of 200,000. And then we do this 4 for 1 stock split. So we end up with 800,000 shares, 800,000, 4 times the 200,000, times 25 cents par. But so now the common stock account, instead of having 200,000 in it, now has, still has 200,000 in it. So the common stock account the dollar amount in the account doesn't change. You see there? So if you try to make an entry, there's no entry you can make. There's no dollar amount to transfer. So what do? Well, what we do is, instead of doing a dollar journal entry, we do something called a memorandum journal entry. And so in the general journal, a memo is written. A little, a passage is written in the general journal. And what it's going to do is outline what's happened here. So let's say that this happened on January or June 5th, 2020. What you would do for this memorandum entry is just prepare a sentence that indicates what happened. You would say something like, on June 5th, 2020, the company affected a 4-for-1 stock split. So you'd tell, okay, on the date, June 5th, 2020, we had a stock split. So you got that covered. Next thing to do is look at the par value or the number of shares, any order, say, effectively decreasing the par value from $1 to 25 cents per share, and increasing the number of shares from 200,000 shares to 800,000 shares. So you create a sentence that includes the date, that it was a stock split, the old par value, the new par value, the old number of shares, the new number of shares, and that's it. And you can do this in any order. You could say that you can start off with the par value is changing, and then the number of shares changing, and then the date, and then it say it's all because of a stock split. Now, just sort of a parting shot here with these stock dividends and stock splits and so forth. With a stock dividend, there's going to be a transfer from your retained earnings accounts to your paid in capital accounts. So there's going to be a transfer from one to the other. However, the total equity will remain the same. Total equity will remain the same. So this is with a stock dividend. With a stock split, there's no transfer. So retained earnings is the same. Paid in capital is the same. And total equity is the same. So just bear that in mind. Let me just say that we're getting into dividend distribution, and you can see from this first example that the dividend amount is $65,000. The par values for the preferred and common are stated up here. The preferred dividend rate is 6%. So even though the dividend hasn't been paid in the past 2 years, if the stock is non-cumulative and non-participating, we simply start off with the total dividend. We provide the preferred shareholders with their dividend for the current year only, $200,000 par, times the 6% dividend rate, gives them $12,000. And then the remaining amount, all of the remaining amount, goes to the common shareholders. So there we go. So now let's move on with this example, same example, but this time let's assume that the preferred stock is cumulative. So as you can see here, we have the same example. The number of shares preferred is 2,000, common is 370,000. The par value per share is $100 par per share for preferred and $1 for common. And you'll notice that when the dividend is expressed as a percentage of the par value, as it is here, the preferred par value tends to be a pretty sizable amount. And then the total par value calculated is 200,000 for the preferred, 370,000 for the common, a total of 570,000. total dividend that we're going to give out again is 65,000. So this is exactly the same information that we had for the prior example, but this time we're going to assume that the preferred stock is cumulative. So the dividend hasn't been paid in the past 2 years. What we've got to do is go ahead and give that dividend, pay that dividend to the preferred shareholders before we can give any to the common shareholders. So again, the total dividend, let me just make a note of that, is 65,000. And now let's go ahead and provide the dividend to the preferred shareholders. We've got the first year arrearage is 200,000 par times the 6% gives us 12,000. Repeating the same calculation for the second year's arrearage, 200,000 par times the 6% again is another $12,000. And then finally, for the current year, we're going to pay the 200,000 again times the 6% dividend rate, another 12,000. And for a total dividend on the preferred, adding these three, we've got $36,000, 36,000. And so we're going to distribute 36,000 to the preferred shareholders. And since the preferred stock is non-participating, the common shareholders simply get the remaining amount of $29,000. So there we go. So pretty easy. You just distribute the arrearages to the preferred, you distribute the current year's dividend to the preferred, and then the common shareholders get all of the rest. So pretty easy to do this. Okay, now using the same data, we're going to be distributing the dividend to the preferred and common shareholders. But in this next example, you see here that the preferred stock is both cumulative and fully participating. Now, what this fully participating means is that, let's say that, you've got the preferred stock, it's got the 6% dividend rate. And so the preferred shareholders get 6% per year. If it turns out that there's enough dividend to provide the common shareholders, say, with 7%, so we've got these preferred shareholders, they're getting 6%. This is for preferred. And then we look at it, and the common shareholders are able to get, we've got enough money to pay them 7%, and we've even got some extra money. If the preferred is fully participating, we're going to have to give these preferred shareholders another 1%, so that at the end of the day, both the common and preferred both have exactly the same dividend distribution with respect to their percentage of par. And that's when the stock is fully participating. So at the end of the day, for the current year, if the preferred stock is fully participating, if the common shareholders get a dividend in excess of the preferred dividend, we've got to make sure that the dividend distributed to both the preferred and common is an equal amount. In other words, the preferred shareholders were able to fully participate in the excess dividend in excess of their 6%. Now, companies can limit this. Companies can have partially participating. Maybe you could have a situation where, the preferred shareholders get their 6%, and perhaps they would get any dividend in excess of 6.5% to common. So if common gets 7%, and that means that they've got a dividend in excess of 6.5%. They've got another 0.5 percentage because it's partially participating now. Instead of participating in a dividend in excess of 6%, it's got to be in excess of 6.5%. So then what we've got to do is, let's see, it's another 0.5%. So we've got to give the preferred shareholders another 0.5% to bring them up to 6.5%, and the common shareholders get their 7%. And there can be any arrangement for this, the limitations or adjustments to the dividend, which makes it partially participating. So because there can be just any array of possibilities, number one, and number two, because what your book is demonstrating, I believe, is this fully participating based on a percentage, we're going to go ahead with an example that is fully participating based on dividend distributions in a percentage of par. So let's see, getting back to this, here's our data. And let's go ahead and get to the calculation. The first part we're going to do is to go ahead and give the preferred shareholders everything that they're entitled to. And we've seen this before. We got to pay them the arrearage. So it's the 200,000 times 6% gives them 12,000. And then the second year arrearage, 200,000 times the 6% is another 12,000. And now we get into the current year, which is the 200,000 again times the 6%, and that gives us another $12,000. And so now we're up to let's see if we've got a total dividend. Let me make a note of the total dividend over here, 65,000. And you'll notice I've got a column for the preferred, a column for common, and a column for the total. And so the total dividend for the preferred so far is 36,000. So there we go. We got 36,000. And now what I'm going to try to do is bring the common shareholders up to speed so that they have basically the same percentage dividend as the preferred shareholders. The preferred shareholders got 6%. Now what I want to try to do, and I say try to do it, I'm going to pay them the 6% if there's enough money. So if you look at it, there's $29,000 left. So if we pay the let's see, what's the total par value? Total par value of the common is 370,000. So if we go with the 370 here times 6%, keeping in mind, just as a subtotal, there's about $29,000 left here, right? So this is a subtotal. 370,000 times the 6%. That's $22,200. And so we got enough money to pay them the full 6%. So 22,200 is going to go to the common at this point. And so we've distributed to the common this other 22,200. And so subtracting, we've got, subtracting it from the 29,000, we've got, what is it, 6,800 left. 6,800 left. And so we've got an extra dividend of $6,800. And so we've got to distribute that, but it's fully participating. So we want to do it in a way that the percentage distributed to preferred and the percent distributed to common is exactly equal based on their par values. And when the stock is participating, it's only participating for the current year. Like we don't bring the common stock up to speed with the dividend arrearages. It's only for the current year we worry about this participating feature. So what we're going to do is, since we need the percentages to end up exactly equal, what we're going to do is distribute the $6,800 proportionately based on the par values, based on these par values. You see the par values? 200,000 for preferred, over 570,000. And then for the common, 370,000 over the 570,000. And so if we distribute this extra $6,800 proportionally based on those par values, it should come out to where the preferred and common get exactly the same percentage at the end of the day. So for the preferred, we're going to take the 6,800 and distribute it based on, let's see, what was it, 200,000 over 570,000. So we're going to multiply this, and what we get here is 2,385.96. So that if you do it, and I paused long enough to where you should have been able to do this, and I hope you did. 200,000 over 570,000 times the 6,800 gives us 2,385.96. And then we do the same thing for common. Let me invite you guys to go ahead and do the same thing for common. So we're going to take the 6,800 times, this time it is 370,000 over 570. So let me go ahead and do the calculation, and please do it yourself. We get 4,414.04. And so if we add the preferred column, they get this 36,000 here, plus another 2,385.96. So what is that? 36 plus 2,000, 38,385.96. And the common shareholders adding the 22.2 and the 4,414, they're going to get, let's see, what is this? 26,614.04. And then if we add these two numbers across, just to check, to make sure, when we add these two, it should total our 65,000. So there we go. So just to recap, first you pay the dividend arrearages, get rid of that. Then you pay 6% for the current year to preferred, and we'll get a total here. And then you get 6% that we pay to the common if there's enough money. If there wasn't enough money, we just reduce it to the amount that we could pay them, and then we'd be done. We'd be done, okay? But since there is enough, we pay them the full amount. Then we figure out how much is left over. And since it's fully participating, we can just distribute the $6,800 proportionately among the two classes of stock to end up in a situation where the common and preferred for the current year get exactly the same percentage of par with respect to their dividend. So that pretty much takes care of that section.